Huge change in taxation. Huge change. And it could affect your estate plan if you're going this method. You okay, big guy? Which I don't like this method anyway, but a lot of people do. Sergio, you're out there. I'm looking at you. I'm doing this video in this room to show off old Miss Betsy there in honor of, we'll call him J and D out of Wisconsin, who some folks I talked to today who are just crushing, kicking butts and taking names. It's amazing how many people think I can't retire in America. And, these guys just come from nothing. They build their assets. They live in a moderate home. They drive moderate cars. It's the same. Just plugging away, saving, plugging. It's the same old story. Raise 3 kids. I don't understand why people think this can't happen in America. It's nuts. All right. So anyway, I'm minding my own business. The anonymous conservative blog. Pablo wants to say hello, by the way. Look at this old guy. Look at this guy. Look at Gruffy. Hi. Is that Stone Pablo? You going to show Stone Pablo? And so I'm anonymous conservative blog. Is great. It's one of my favorite websites. The Conservative Treehouse. I still follow Instapundit quite a bit. Actually, I like the boys over at Instapundit. They're a little bit too pro science, if you know what I'm saying, for me, because we know that science is a joke in terms of the way it's practiced today. For some reason, conservatives, they think NASA is a bag of chips, dude. It's the weirdest thing. A lot of conservatives we got to cut the budget here, there, and everywhere, but not for NASA and not for the Department of Defense. Let's fund more to Ukraine and fund more to NASA, but everywhere else we got to cut the budget. I was like, the Democrats say the same thing. You can cut the budget on the DOD and NASA, but how dare you do it on the EPA? I'm like, this is why we just spend, because no one wants to cut the budgets on anything. Conservatives, NASA for conservative is like Disney for children. Frankly, is what it is. It's just a weird thing to me how much they just think that NASA is all that in a bag of chips. I'm not saying NASA is bad. Not saying anything like that, but just can we get over this infatuation? We're going to be living on Mars. Oh, so dumb. All right, so anyway, we go down here and we're just reading demand for U.S. liquefied natural gas surges amid fears of impending shortage. That's not good. China urges shift from dollar to local currencies for, I don't know what SCO trade is. And then we come down here and we see that video of Hunter Biden watching the 4th of July fireworks at the White House has people wondering if he had a case of the sniffles. Hunter probably doesn't sniff the young girls like Sniffy Joe does. Biden sniffs the white stuff, where they just happen to find some sniffy stuff for the sniffles. So the Sniffy family is large and in charge. That's freaking crazy. Voting machines will not meet new federal standards in time for 2024 election. Shocking. Yeah, so let's just keep going. So I'm minding my own anonymousconservative.blog. I'm scrolling on down here, and I find the IRS has quietly changed the rules around the tax break on a particular kind of trust, often used to minimize the estate tax. He says it's a revocable trust. It's not a revocable trust. He made a mistake there. It's an irrevocable trust. Irrevocable trust. So we go over here to dailymail.com, which is a British rag. And if you want anything news-oriented about the United States, you have to go outside of the United States because we are government propaganda, our mainstream media, for sure. All right. IRS quietly changes rules on how your children's inheritance is taxed. Here's what you need to know to avoid a shock bill. The agency has curbed the tax rate on a particular type of trust used to minimize capital gains. In the last decade, more families have been using irrevocable trust, and this rule will impact its estate planning techniques. They've turned to irrevocable trust to protect their assets from spend down in order to qualify for Medicaid. Now, I cannot stand irrevocable trust to qualify for Medicaid. Medicaid is supposed to be used for impoverished people. That's it. You don't want to be on Medicaid first and foremost. You don't. The only reason you want to be on Medicaid is because there's no other option. If you have enough money in order to put into a irrevocable trust, that way your children inherit, and yet you, the mom, goes to Medicaid facilities, something is broken there. That's wrong. It's not the way it's supposed to be. And as more and more people need Medicaid, we have less and less money in order to provide for the more and more people who need it. Because we have more and more people going on Medicaid because the boomer generation is older and getting sicker. And as such, people who use this technique. So what happens here is I have $2 million, we'll just say, I don't want that to go to Medicaid or to go to long-term care facility. So I'm going to, and at the beckoning most likely of my children, I'm going to set up an irrevocable trust. I'm going to gift this asset to my irrevocable trust. I'm making a gift. So people say that gift is subject to gift tax. No, it's not. I mean, if it's over whatever the gift, $10 million is whatever the gift tax exemption it is, sure. But if I give $2 million to my irrevocable trust, that is I get an annual exclusion off that. Yeah, I think it's $16,000 this year, not much. But I get a lifetime exclusion. I think it's like 10 million bucks. I can't remember. It's inflated now, but it's a huge lifetime exclusion. So all that money makes its way from me to this trust. It's a gift. All right, now you can't, you could do it. It'd be stupid to give IRA assets, but you give non-IRA assets. All right. So what happens here is I give let's say I have Apple stock I bought in 1997. I bought it for 10. Now it's worth $300. I have no clue what Apple stock is, but just hear me out. So I gift this Apple stock to this irrevocable trust. All right. Now that irrevocable trust carries the cost basis of that $10. All right. So anytime you're making a gift to an irrevocable trust, or you're giving me equity, a stock essentially, the cost basis carries over. So if I were to sell that stock for $300 as what you had given to me, and the cost basis was 10, I'd have a $290 capital gain. Does that make sense? Yes, it does. So if I gift this stock to that irrevocable trust has a stock. All right, it's out of my estate. The growth is out of my estate, and in theory, I'm not supposed to have anything to do with that. It's supposed to be held at arm's length. A lot of times, a family member will be a trustee, and the family member will use that asset from the irrevocable trust to benefit me. And essentially, I still kind of in control a lot of times. And that's what happens all the time, is I'm still kind of in control, and thus I haven't really made it a gift. It's not a true gift. And the IRS audits this stuff, not as much as, I hate to say as much as they should, but they do audit this stuff to see if you are actually if you're still kind of in charge. If you're in charge, they're going to ignore the trust, and they can say, no, it's right back into your estate. If you look at like some estate law practice, things like this nature, you'll see that happens quite a bit, where the IRS says, no, that was still back in your estate, thus it's going to be taxed in your estate. You actually did not make the gift, if that makes sense. So what happens now when now I'm out of the equation? The irrevocable trust gets it, all right? So the irrevocable trust now, not part of my estate, it's not subject to estate tax. The income from the irrevocable trust can come back to me for sure, or somebody else, because you don't want to retain the income in the trust, all right? So does this make sense? So now the irrevocable trust owns $2 million of Apple stock with a cost basis of 10, all right? So check this out. So now the agency has curbed the tax break on a particular type of trust used to minimize estate tax. All right, let's keep going. Prior to the new instruction, it is unclear whether the tax policies around assets passing to beneficiaries through an irrevocable trust. But the IRS has ruled that these trusts will now be subject to capital gain tax, or as before you thought they might not be, which will have a substantial impact on estate planning for Americans. All right. Typical assets that are disposed of during a person's lifetime are subject to capital gain tax on the increased value of the asset over time. The tax owed is largely determined by the difference between how much was purchased and what the account is worth, as we talked about. The exception to this rule is when assets such as property are passed on to the beneficiaries at time of death. That's called a step-up basis. So I, Josh, have $2 million. All right. If I die, my kids inherit that $2 million with a cost basis of $2 million because it's a step-up basis at death. However, if I have $2 million in my estate, I can't qualify for Medicaid because I have $2 million. So basically the people who control the nursing homes are going to get their hands on that money because they said, we're not going to give this to you for free. You got $2 million. So for me to say, well, I want my kids to receive a step-up basis, in theory, I transfer it to the irrevocable trust, hoping that they get a step-up basis, and I remove the asset from my own estate so I qualify for Medicaid, not Medicare, Medicaid. You see what I'm saying? So now they got the money over here. I die. Again, it shouldn't really have any effect on me, but when the kids inherit it, theoretically, they'll have a step-up basis. That's what it was. Now the IRS is saying, no, it won't be a step-up basis. All right. The death of the owner gives the recipients a step-up in basis, so they can inherit the asset as if they just purchased it at the current value rather than when the true cost basis. This in turn eliminates any capital gain tax. Prior to the new rule, which was introduced in March, transfers from irrevocable trusts have generally been receiving this tax break. You hear that? Prior to the new rule, transfers from irrevocable trusts have generally been receiving this tax break, the step-up of basis. However, the new ruling states that any property held in a revocable trust that's not included in the taxable estate at death. That would be me. So I have the money I put the money in the revocable trust. It's not included in my estate at death. That's why I could qualify for Medicaid. It's not included in my estate. I don't own it. And it's not included in my estate at death either. All right. And so because it's not included in my estate at death, theoretically, my beneficiaries upon my death, or whatever the irrevocable trust document says, would receive the step-up in basis. All right. And that way, again, I qualify for Medicaid, which is stupid. But anyway, now, however, the ruling states that if it was not held in my taxable estate at death. That means Americans are now likely to be subject to a substantial cost if they do not take these new rules in consideration. For example, if a couple bought a home in 1975 for 100,000 schmackaroonies and it's now worth 250, if they want to sell their home, they'll own capital gains on the $150,000 growth. Well, they really won't, because we know you have a 500,000 exclusion on your home appreciation. But be it as it may, we go with it. Prior to the ruling, if the couple had transferred their home into an irrevocable trust, the trust could sell the home in the cost basis of $250, and no capital gains would be due if the proceeds were then distributed to the children. You see, so if I sell my stock, if the trust sells that stock of Apple at $2 million with a cost basis of 10, and they distribute the proceeds to the children, it's all step-up basis. There's no capital gain tax due. I would not, if I was an estate planning attorney, I'd be hesitant to declare that, because that seems still way outside of the letter of the law. But right now it's settled, apparently. The IRS says that is not the letter of the law. Thus, you can't do that anymore. In order to qualify for Medicaid, people will frequently have to have a spend down of your assets in order to meet the required level of income and assets. The income guidelines offered differ depending on the state, but people usually spend some of their income or assets on healthcare and medical related costs. One of the only tools people use to protect assets from being subject to the spend down was an irrevocable trust. This ruling does not mean that these trusts are no longer useful. It just takes careful planning that your kids are going to have to pay capital gain tax upon the receipt of the money, which they should. Many families will not find themselves subject to estate tax when the value of their home is included, because the current federal tax is only about $13 million. But anyway, if you currently have an irrevocable trust or considering one, seek advice from a financial planner. Let's see if there's any comments on here, because I'd like to see that. Let's check this out. Stupid. I do not know. Pablo? No. Oh, Finney's out there. Hold on, let me get him. And this is stupid right here. I do not believe it's legal for the IRS to make wholesale changes to tax law without congressional approval. That's dumb. IRS makes its changes all the time, and the rules, 100%. And the reading of what the congressional intent was. That's a stupid thing to say. The change would never make it through the House if a Republican wins in 2024. It will be stopped. Why do you care? So more rich people can qualify for Medicaid? That doesn't. I literally don't understand this level of thinking, Republicans. Oh my goodness, we got to stop the rich people from paying more tax. Do you think the rich people care about you? They don't, man. You don't want to be on Medicaid. It drives up. Look, again, there's people out there who do it, are righteous people. My man Sergio, I don't know if he's doing this or not, but he got mad at me a couple times because I made this exact case I'm making here. Medicaid is for poor people. If you have the money, you should pay for your own way, man. If you got the money, and again, people say, oh, but Josh, you talk about being poor on paper. Yes, I do talk about being poor on paper. You know how we get poor on paper? We pay the tax now to be poor later. It's a trade-off. Pay the tax now, be poor later, be poor now, or pay the tax later. I don't care, but I talk about you're still paying the tax. Here, you're getting around the tax code by saying we're going to use the irrevocable trust in a way so we can pretend we're poor on paper, so a way grandma can qualify for Medicaid. But that every single person that qualifies for Medicaid that has the money is robbing someone else to qualify for Medicaid that doesn't. There isn't enough money. Medicaid is funded by your state and the federal government, which means you are relying on you're socializing basically what I always say, privatizing the profits and socializing the risk. You're saying, I want my money to stay in my little bubble here, my family unit, and I want the rest of the country to pay for it. I don't find that, I find that to be bad. I don't think you should do that. If you've been blessed with a couple $1,000,000, you should pay your own way. You should not rely on the taxpayer of friggin' Joe and Mom Schmom who's making $50,000 a year. You shouldn't do that, especially when Medicaid is broke as it is now, and people still do need it. I don't like it. Never liked it. My thing of being poor on paper is you're paying the tax now. You're not avoiding the tax. You're not pretending you're poor. You're saying, I'm poor now because I paid all the tax they want today. And that's what you do. That's different. That's a whole different ballgame. Roth conversions, same thing. You're still paying the tax. Here, there's no tax being paid. You're just gifting the assets. Your kids are getting it in order to qualify for a government program you really shouldn't be qualified for. Take your income, tax, buy the property, it's taxed every year, pay property tax or whatever. It should be illegal to tax already taxed income what hasn't been taxed as income and assets. That's stupid. It's not illegal. It's not, you haven't taxed the income, my guy. The assets, it's capital gain. Anyway, so this is big. We got some, I don't have any qualm with this at all. I don't. It's always perturbed me. And on top of that, we have the FTC starting to crack down on some corporate monopolies too. So as much as I can't stand Sniffy Joe, there are a couple of things that are coming out of DC that at least make sense. And this is one of them. Again, you should pay your own way. You shouldn't rely on your taxpayer. What if you just went door to door? Hey, like let's just say I went down to my neighbor. They saw my nice fancy schmancy house. They said, and I would knock on the door and say, hey, I'm going to put my mom in a Medicaid facility. Will you help me pay? You're like, well, you got $2 million. Yeah, I want to keep that for me or my kids, so you can help me pay. You never do that, man. Yeah. Love your thoughts. Don't get mad if you're out there. It's just my opinion. Doesn't mean I'm right. Just my opinion. But love your thoughts. We'll see ya.